Welcome back to Tip TV Finance, where we are joined once again by Alessio Rustani from leadingtrader.com. How are you today, Alessio?
Thanks very much. I'm glad to be here. And in this session, what I want to talk about with you, Zach, and with your viewers is something that I think you'll find very interesting and fascinating. So I want to begin by asking you this question, yourself, Zach, and from your viewers. What if you had a trading strategy that lost every single time? I mean, let's say you had a 90% losing rate. All right. Now, you might think, well, why would you even want such a thing? I'm sure many people have said this, people maybe who actively trade or maybe have done investments, and maybe you thought, and basically, what if, for example, every single time you placed a trade, it ended up being a loser? And at some point you thought to yourself, wow, if only I had done the opposite of that decision, I would have made a winning trade every single time, right? I would have won more than lost if I'd just done the opposite, right? I'm sure that thought may have occurred to some people at some point. And we actually thought, you know what, that's a great idea to do as an experiment. Why don't we actually do that? Why don't we test it and see what the result would be? So let's begin by showing you what we did. So what we did was we actually built two algorithms. One is called the master algorithm or master strategy. The other one is called the slave algorithm or the slave strategy. Okay, and the master algorithm, essentially what it does, it takes trades based on a losing strategy, and the slave algorithm on the right, all it does is reverses that instantaneously. So whatever the master algorithm, the master strategy does, all it does is the opposite. Right. Okay, and we actually built these two algorithms side by side. So just as an example, Zach, imagine, for example, you went long, or somebody did buy pound dollar at 125. The slave would just do the opposite, sell pound dollar at 125, the same size. Selling S&P at 2300 on the master, the slave would do the opposite, buy the S&P 20, and so on and so on. I want to just ask your viewers, just have a think about what do you think the result would be based on this. Okay, but let's continue to the next slide. So basically what we did, and we thought, okay, how can we make the master strategy as high a losing ratio as possible? So we deliberately made the master a highly losing strategy. So what did we do? We broke all the traditionally good rules of risk and trade management, which is we used very tight stops. Using very tight stops is a usually bad idea because essentially you lose more. Although it might increase your risk reward, but it does lower your win ratio. Random and aggressive entries and no proper trade management, no break-even rules or anything like that. Number four, we trade in very low time frames. Trading on low time frames is 5 minute or 15, whatever, even 1 minute charts. I know you like 1 minute charts, Zach, but essentially what we're trying to do is make it as aggressive a strategy as possible. And of course, over trading, just breaking all the rules of over trading and over leveraging and everything else. Okay, so what do you think?
Which is what most people do.
Yeah, exactly.
This is, the master is basically doing what 90% of people do.
That's right. And if you think about it, the slave, kind of the idea behind the slave strategy was, you know what? What if this is kind of like the traders who are doing the opposite, or taking the opposite side of the action of the average trader? The insiders, or whatever you call it. Okay, let's continue with the next one. So take a look at this. These are the actual results as produced by our algorithm. So we got the master algorithm, master strategy at the top, and we got the slave strategy, the reverse trading method at the bottom. And you will see there's two trades there, Germany 30 and dollar yen. Germany 30 on the master was a buy, and you can see on the reverse strategy was a sell. Exact same size, exact same time, everything done exactly the opposite. And one thing I should just say, by the way, as well, as soon as the master trade closed, when it hit the stop loss, the slave algorithm would also close the trade. Okay, so they both start and finish at the same time. So if we just go back to that same chart again, same table, guys. So as you can see, the results are not identical. Here's what we thought. This is the assumption we made. We thought that the result of the reverse trading, or the slave, would mirror exactly 100% or close enough to the master. The master lost 412, but the slave, the reverse trader, made 271. Now I'll come to an explanation of this in a few moments. So it wasn't the exact same gains as the master. And finally, we go to that last slide, guys. So here's some more results for you, as you can see here. So again, master strategy, slave strategy on the right. The master lost minus 1362. Now that could be pounds or dollars, whatever you want. And the slave made half of that, 741. Now, essentially this experiment proves, in my opinion, why reverse trading is a bad idea, and reverse trading does not work, because there are two things that are going to go against you. And I've written them down on this chart. Number one, the broker's spread. As we know, brokers always put a spread. And in that minute spread, whatever that may be, will mean that you will always make less than your losses. So your gains on the reverse are always going to be much less than your gains. And also, the fact is that you only need the master to make one winning trade, all right, for essentially to evaporate all the gains on the slave, on the reverse trading algorithm. Essentially, what I think this experiment shows is that reverse trading is a bad idea, and instead of that, focus on actually building a good strategy. Zach,
there's no alternative to just getting it right and being cool-headed and just doing things in a rigorous way, which nobody does.
Yeah, absolutely. Well, I think what this puts, in my opinion, a kind of a nail in the coffin of this idea that if I just done the opposite, well, in theory that makes sense. But as we've seen, we built two algorithms, one doing the opposite of the other one, and the results, even though, yes, okay, you made winners every now and then, but those winners were half the amount of what you would have made. They were not exactly the same.
We shall see what the reaction is. Alessio Rustani from leadingtrader.com, thank you very much for coming in today.
Thank you.
Hi, this is Alessio Rustani, and thank you very much for watching this video. If you like this video and you'd like to see more videos like this, then please remember to subscribe to our channel and like our page. And you can also visit me on my website, leadingtrader.com. Thank you very much.